My name is Ingrid Jarrett, President and CEO of the BC Hotel Association. I'd like to welcome you for joining us for our webinar this afternoon. I'll just go through a few housekeeping items, and I see we do have several people still signing in from the waiting room. So I'll just give another moment or two, and then I'll just talk about the recording and the process of the webinar today. So Carrie, I think we'll just give it another minute or so while people are still signing in.
Great, sounds good.
Good afternoon, everybody. I see we still have quite a few people that are signing in, but I will just welcome you this afternoon and thank you for your time and your interest in the webinar that we're co-hosting with Colliers and HVS. I'll just let you know that this webinar is being recorded, and please keep yourself on mute during the webinar. The webinar will be about 45 minutes, and then we will have a Q&A. We will do our best to address the questions that were sent to us during the registration timeframe. And then there's a chat function at the bottom of your screen. And once we have gone through our presentation, we would welcome you to put questions in the chat, and I'll help to manage that. So Carrie and Russell or myself will be most pleased to answer any questions that you may have. And given that we have 2 minutes after the hour, Carrie, I think we'll go ahead and people will join us as they're able, just respecting everybody's time. So again, thank you so much for your interest and signing on to the webinar today. You know, the background of our industry, of course, is one that has seen extraordinary growth, leading Canada not only in developments, but also in RevPAR, and really looking at our position in the international markets over a run of several years. Given that we're in the 15th month of this pandemic at a time when hotels are reeling from minuscule RevPAR numbers, occupancy in urban areas is critically low. And we're all looking at the current landscape and what does it look like between now and when we're actually in recovery. I'm very encouraged to be able to state that over the last couple of weeks, I've had a series of meetings with government and with my industry counterparts, and we're rolling up our sleeves and we're getting to work on the phased reopening plan. And I know that'll be good news to everybody on the call. That doesn't mean I know when, and that doesn't mean that I know what's going to happen on May 25th, but it does mean that the work is being done, so we're prepared as an industry to recover and ensure that not only do we protect our summer, but that we also look to the fall and the future for the success that we've seen historically. So I'd like to acknowledge and thank Carrie Russell for joining us today. You know, we worked very closely over the years with our conferences and making sure that we have industry intel supporting the market. And I know that as a professional that not only our banking community, our real estate community, and our hotel community looks at for expertise, valuation, business plans, should I build a hotel here, or, you know, how do we evaluate them? I'm just delighted, Carrie, that you've made yourself available with your expertise today. So thank you so much. And Russell Beaudry, I know that Colliers also is an amazing partner for the hotel industry, and we really appreciate you coming. We've had many questions from the industry around hotel valuations, buying, selling. Some hotels are being repurposed, and it's a time that I think we all kind of take a step back and need to look at the lay of the land, and hopefully we'll gain an understanding during the webinar today of what the markets are looking like and potentially what recovery might look like too, even though I know that none of us have a crystal ball. So Carrie, over to you. Thank you so much.
Thank you, Ingrid. Yeah, we really appreciate this opportunity. And, you know, I'll start off by thanking Russell for joining me today. We want to cover the transaction market, and really you want the brokerage community to be at the table with that. So I see Russell as being it's like the Wizard of Oz. When you pull back the curtain of Colliers, and Hamir and Tom Andrews and Alum and Rob McCluskey, the team of Colliers is a well-known group, but behind them is their genius, Russell. So I'm excited that he has been willing to join me today and come to the front of the stage and talk. So we're going to whip through some historical information fairly quickly, because we really want to get into the transaction side of the market. And if you're looking at buying, selling, investing in hotels, that's kind of a more interesting place to spend our time. But in order to set the stage for that, we really need to know where we're at in the cycle and where we've come from. So probably at this point, you've seen this slide more than a few times. It just gives an example of, or some historical context to where we're at in this this downturn. I guess we've tipped the corner in this cycle. So we've sort of had three phases where the demand has gone in a negative direction in the last 20 years. We had in 2001 with the 9/11 and that crisis. We saw demand decline about just under 3% that year. We got to 2003, which was a tougher year for Canada with SARS. We actually had mad cow disease that year. That was an impact. So demand in that year declined almost 5%. Then we got to the great financial crisis in 2008, 2009, and we saw an almost 7% decline in demand. Now, you'd think it would be logical to put 2020 on this chart because it's behind us now, but unfortunately, the demand decline was so dramatic in 2020 at 52% that you skews everything else in this chart. So it gives you that context that things were horrific. You really can't describe 2020 as being anything other than that, with a 52% demand decline. There's no real comparison. Occupancy ended at 2020 at 30%. We had a 0.6% increase in supply in 2020. We were probably expecting something closer to 1.5% increase. So we didn't have as many rooms operational in 2020 as we might have expected, but that was a function of where the market was at in terms of demand. If we look at ADR change, so we've got ADR in blue and we've got RevPAR change in red. Our ADR changes coincided with the years that we had declines in demand. And so overall RevPAR declines, the worst that we saw was during the great financial crisis at just shy of 11%. That compares to last year's RevPAR decline of 62%. So you can see why we want to kind of whip through this section of the presentation, because it's behind us and it's painful to even have to revisit. So taking a look at the weekly occupancy trends, we've got 2019 in blue, and then we've got 2020, and then moving into 2021 in the red bar. You can still see that we're off in occupancy almost 62% year over year. So we had the worst of the cycle was last April, 2020. Things improved. We peaked about the second or third week of August last year, and then in the fall, we didn't see the recovery in the commercial corporate traveler that we would have liked to have seen in the fall. And then, of course, we had second waves and third waves of infections that have brought things down again. So your occupancies, if we divide it up a little bit by province, downtown Vancouver, easily the worst hit and one of the worst hits across the country. In April last year, it was just under 5% occupancy. Recovered back up to about 30% occupancy and is now sitting 15% occupancy in the most recent weeks. The airport market was a little bit more even in terms of the trend. Its low point was 30% occupancy, only came back to 46% occupancy in August, and now with the quarantine business, it's sitting about 41% occupancy. Moving over to the island, if you look at Victoria, low point of 13% occupancy, peaked at a high of 58%. So in August, you could start to see that leisure demand active in the Victoria market. But now with all the restrictions that are in place, we're back down to 18% occupancy in the most recent week in Victoria. And then the Okanagan, which is kind of a Canadian good news story and shows us that people really do like to travel and want to be active and moving around when they can. Low point was 13% occupancy last April. by the summer, occupancy was back up to 77% for the third week in August. So certainly that trend didn't play out for the year, and there was a lot of pain felt in the Okanagan as well. But it did show you that when the infection rates were low and people were comfortable traveling, demand was coming back. Now with the restrictions in place, we're sitting about 31% occupancy in the Okanagan. Average room rates, we'll talk a bit more about average room rates as we go through this presentation. It's really going to be a question mark around the recovery. If average room rates come back, we'll see a stronger recovery than will possibly be the case if we don't get that compression and build rate again. But there's still quite a gap in average room rates. We're down over 30%. When I'm looking at numbers and markets right now, and my optimistic side says that the rate situation is a function of the demand that's out there. So there's been a lot of compassionate demand, long-term stay demand. We haven't seen our normal travel market come back yet. And that's why we're seeing the gap in rate. My cautious side says we don't have the compression in the market. It's going to be a while before we get that compression back. So will we close that rate gap again? So it's kind of, it remains to be seen a little bit, but we certainly know that the numbers are showing that the rates are off. So we're in a situation where we had RevPAR under $20 in the province during the week stats through two of these troughs, and we're still over 70% off in RevPAR where we sit in our current week. So I'm just going to jump right in and give you the money stat in terms of the forecast. I call it the money stat. I don't know if it's worth anything because it's been consistently off. That every time that we try and put out a forecast, we're revising it. This forecast represents what we're looking at for 2021, 22, 23, and then what we think will be full recovery by 2024. I can tell you that we're probably a month over when we last created this forecast. I know that CBRE came out with some stats yesterday. They're looking a little more conservative than these numbers. So it kind of remains to be seen how this recovery plays out for 2021. But I think we're in agreement with the other companies that are doing forecasts in the market that by 2024, we'll be back to a place that looks a lot more like 2019, but it's not a quick turnaround. The underlying assumption on our 2021 numbers is that the vaccine rollout is completed by September. And we've got some sort of reopening of the US border. And I guess it kind of remains to be seen if that's with vaccine passports or what type of testing and whatnot has to occur. But we will start to see some more north-south travel starting in order for these numbers to play out like we've forecasted. So having kind of set the historical context, I'm going to throw it over to Russell and get his thoughts on, I'll back up on the transaction piece, get his thoughts on these forecasts and where he sees things in the recovery cycle.
Yeah, thanks, Carrie, and thanks for having me, Ingrid, and everyone. So we're in agreement with a multi-year recovery, and it'll be really interesting to see in 2022 if we can get ADRs to compress a bit quicker. And I think that will provide a lot of support if that does happen. So I like the forecast. I'm sure it's always evolving and difficult to peg down, Carrie, so good work. So we wanted to also speak about where we're at in the recovery, and I'll quickly go through some of the points, and Carrie will jump in as well. We're really in the first inning of the market recovery. At the very start of the uptrend, hopefully comes back sooner than later. And it really depends on where a hotel is located and the market segment it operates in. And the US is offering a great preview today on where things are headed, particularly with leisure markets. And their occupancy in recent weeks have been in the high 50% range, and weekends in the 70% range, which is reassuring. That being said, we're still stuck in the kind of 30% range, just a little bit less on average in the month of April, with no real weekend boosts at present. So, with the vaccine rollout a couple months ago, we were at 15% at the end of March in terms of population having one dose, and today we're just over 45%. And in BC, I heard an interesting stat yesterday by the health minister, 70% plus of the population over 40 years old in BC have at least one shot. So we're working towards really in an expeditious manner now, getting these vaccines in people's arms. So that's all reassuring. And, notwithstanding this painful third wave that we've been through and the frustrations that everyone is dealing with, the cases have crested and we're working our way down. So there is a lot of hope with the vaccines and with the case counts declining. In terms of why we'll recover, it's going to be a leisure-led recovery, and fortunately, BC has always had a higher proportion of leisure demand and higher occupancies and rates than the Canadian average. And in terms of leisure, everyone's view, I would hope, is, there's a lot of cabin fever out there, and hopefully there is a rush once things are safe to reopen for the leisure traveler to come back safely, and hopefully the psychology changes quickly. I had my first shot on the weekend, and I can tell you it's a good boost to morale, just like for the mind, and hopefully we turn a corner pretty quick. And then I'll leave it to Carrie for just touching on some of the other market segments that we're seeing in terms of the recovery.
Yeah, so the other ones that we need to fill in, so we saw leisure come back last summer, and I'm in total agreement with Russell that people want to move around. We're getting sick of being at home. So the meetings and event market, I don't think there's a lot of confidence on booking meetings and events in 2021. The fall and early winter months, there are people putting things back on the calendars, but I think there's a lot of caution that where will we be at that point, and is it still a risk to book a meeting and event? So we're really seeing that as being a 2022 recovery in the meetings market. And it'll start to be the social groups and small corporate groups that are coming back in 2022. The brands are talking about some good booking trends for 2022. We're seeing major events happening in the US. So if we're taking our cues from what's happening south of the border, the hotel industry, the Hunter Conference had 300 people signed up 2 weeks in advance of the event. It would normally be a 2,000 person conference. So they had 300 people signed up 2 weeks in advance of the event. When the event actually happened, they had 1,000 people, and then probably another 200-300 shadow attendees that don't pay for the conference, but they lounge lizard and hang out at the cocktail parties. So, a 1,300 person event is still a bit mind blowing to me, but it shows the psychology of people are willing to come back to these meetings. So we think that we'll start to see that. We also think Vancouver is well positioned as in the long term as a convention destination. I think that with this technology that we've adopted and being able to meet virtually and that kind of thing, hybrid meetings are going to be kind of a commonplace activity in the future. And so it's going to have to be a draw of the destination. So, I remember the Appraisal Institute of Canada, and as much as I like to network and enjoy those events, I'm going to be hard pressed to convince me to go to the Winnipeg event or the Edmonton event if I can do it virtually. But if you put Vancouver on the conference calendar, we often, Vancouver, Kelowna, both of those destinations always get really good attendees. So I think BC is well positioned for that meetings and events market to come back. And also sidewise, if there's smaller events, we're not on the same scale as some of the mega events that other places host. So the corporate side of the market is really important for the urban recovery. We don't expect to really see the corporate market start to come back until potentially after Labor Day. That's when we're starting to hear that companies are bringing people back into the offices. There is definitely pent-up demand for people to want to be back in their office, maybe not a 5-day a week back in their office, but I think people are ready to start working together, and some of the office REITs and these various organizations are indicating that there's some desire. Marriott had some Q1 indications from Greater China that shows their business market is 5% higher in 2021 than it was in 2019. So that's pretty encouraging that we've got markets that have are showing some strong recovery. One of the concepts that's coming up and is talked about in the corporate market is this bleisure, this blending of business and leisure, and no clear purpose on what the trip is for, but people are traveling nonetheless. So you are, again, well positioned in BC to capture that bleisure travel where someone has to do some meetings, they have to do some events, but they'll spend a little more time. They might take family members with them. And so I think that's something that the hotel industry is paying attention to and trying to figure out how to accommodate that combination demand. One of the other things that we are kind of curious about paying attention to is that if companies have downsized and limited their office space and you're having to do hoteling type models in your office where you book your desk and you're in the office 2 or 3 days a week, there's still going to be need for the team to come together on a somewhat regular basis. And I think that's something that hotels should be paying attention to, is that, whether they're bringing corporate teams together for leisure and social activities, or whether they're just that space where the corporation can now meet and that they don't regularly get together as a group. So paying attention to that. And I think that's a longer term trend that potentially can assist in building back some of this corporate demand. So one of the questions that I'll pose to Russell, or we can both kind of touch on, is Russell, do you think we're going to come back to 2019 levels?
Eventually, yes. Yeah, and it's about building back the market segments, and it will take a few years for those to coalesce together in order to get compression in ADR and get those sellout nights, citywide sellout nights in the cities, and the ability on the weekends and leisure markets to really raise the rates. And there's one-offs to that. So, a Tofino or a Kelowna in the summer will obviously be full capacity. But on the margin and overall, as an average, it will take some time. Mm-hmm. Yeah, and the urban markets will have a little bit of a longer recovery time.
Yeah, I think we're kind of in alignment. Like leisure demand, the domestic leisure is a check mark. It's coming back. I think it's the first one to come back. I think we've got some confidence that we're going to start to see corporate demand filing into the market into the fall. So that's kind of another check mark. I think that we'll start to see regional conferences, domestic conferences, certainly social events. I mean, there's got to be, I think all of us are just going to spend 2022 going to weddings and family reunions and all of that. I'm sure there's a ton of events that will come back. So I guess the piece that we're watching closely is that international traveler. What's that going to look like? And larger scale conferences. And until we have some confidence that those are coming back into the market, there'll be a question mark on what kind of compression we're getting on the average rate. So if you look around the province, and I don't want to be too Vancouver centric in this, if you don't rely heavily on international travel, or you don't rely heavily on conference travel, you're probably coming back quicker than that 2024 number that we're saying. Whereas downtown Vancouver 2024 is, I would say, realistic, and the question mark there is, does rate actually come back by 2024? Probably yes on demand, question mark on rate. And
then also just going down the P&L, the profit and loss statement, we're likely going to have some surprises, good and possibly bad, with operating expenses as well. And that's to be determined. But Carrie, maybe we could just chat quickly. I know we were talking offline earlier about some of the service offerings that may change just due to the pandemic and for cost savings reasons. And did you want to give a few of the ideas that we were discussing?
Yeah, I mean, I guess that, one of the things that we've seen coming out of prior cycles, so if you go back to the 2008, 2009 downturn, we saw that hotels were able to retool a bit and look at everything that they were doing and create some greater efficiencies. So you got more leverage when your recovery started to happen and the top line started to improve. You had a better bottom line potential. It'll be things like what's the service expectation for guest room cleaning? What's the service expectation for food and beverage? I think across the board, restaurants are really rethinking how they deliver the service offering, and that could in some ways be a good thing because they've found more efficient ways to do things in this environment. So yeah, I think operating leverage is a positive thing that may help hotels recover the bottom line a little quicker than the top line is coming back. Yeah, I don't know, have I missed anything on that topic? Are we ready to jump into the transaction market?
I think we can go into the transaction section.
Yeah, so Russell's going to give us an overview of the transaction landscape and what's happening in terms of trades in the country and BC specifically.
Great. So we have this long-term transaction volume, nice graph that is 21 years, 20 plus. And it's really, you could divide it into in terms of 10 years. So in the first 10, broadly speaking, we had years, and if you look at the blue, that's the traditional volume, and I'd like to focus on that. Those are the mainstay hotels that trade across the country. The gray portion are larger portfolios that have a special reason for trading, and they're and not entirely or exclusively, but in the last half of the second decade that's presented, it's a lot of foreign capital as well. So if you strip out the strategic and you focus on the traditional volume, in the decade of the 2000s, we had about $500 million in annual traditional transaction volume. And if you fast forward to the 2010s, we were at $1.3 billion. So it's significantly elevated amounts of liquidity in the market, and there's more transactions, there's more people that are willing to look at Canada as a destination for investing in the hotel market from a cross-border perspective, and it gets other groups that might not be traditional Canadian hotel owners active in the market, whether it's a complement to their existing portfolio or some other special reason. So the increase in liquidity is something that we benefited from in the last decade. We came off of a very good base of transaction activity leading up to 2020. So we had just under 900 million of transaction activity in 2020. And we'll get into some of the breakouts of how that was comprised. But the key point that I wanted to make was it was still higher than 2009 and 2010, those years. And we ended up still having quite a bit of activity, notwithstanding the turmoil that occurred last year from COVID. And just keeping on this chart, if you look at 18, 19, we didn't have any strategic volume in those years. And we did see a shift where there was less foreign capital and more of a shift to secondary and tertiary markets across the country, where investors were more focused on assets that were not urban centric. And that, probably the main reason was there wasn't a lot for sale in the cities. But in any event, it's important to set up these cycle dynamics and the discussion that we're having. We came off of a very good period for hotel transactions, and more or less it had never been a better time for valuations and for liquidity for owners to transact, buy and sell. There was a lot of capital in the markets leading up to 2020. So digging into the recent year 2020 and 2021, we did have quite a noticeable pause in the first quarter of last year. And for the year, 53% of that total volume in 2020 was for alternate use Most of that was for government purchases for social housing or the like. In BC, for that, the province's total transaction volume for the year, 70% was actually for social housing. So it was definitely a larger portion in BC. In terms of distress sales, and this is something that is important to realize, receiverships and foreclosures didn't happen en masse, thankfully, and it turned out to be very minimal. We only had 4 transactions in Canada of 71 that sold in distress last year, and it was 2% of the transaction volume for the year. Notwithstanding, we did have activity. It was more or less a no bid market where things did not happen because the market did pause. But by the fall, there was encouraging signs that activity was picking up, and realization that there was liquidity in the market, and investors were encouraged by the positive vaccine clarity. And it did provide a lot of optimism, especially in the world that I work in. And out of the gate in 2021, I'm pleased to report that we've had some really encouraging activity in terms of closed deals. So there was 21 hotels that sold in the first quarter. About half were alternate use, but we did see an uptake in traditional hotels transacting, and lenders coming back as well, with caution. But there's a lot of encouraging signs at present. And then for the back half of this year, for 2021, we're pretty optimistic. We're anticipating we'll see over $1 billion in sales for the year, which is on pace for the average over the last while when you look at traditional deals. And we could possibly see the resumption of some strategic trades. Maybe it's a little too early to call that, but in the next while, we may see some large transactions that close. And we haven't really seen that in Canada really in a few years. So for turning to BC quickly, I have the chart at the bottom there, and you could see that activity did slow down quite a bit in 2019 off of a strong 2016, 17, 18. Operating performance was just so good in 2018. I think most people didn't want to sell. So we did have a slowdown in 2019 where owners were focused on their existing portfolio and benefiting from the good operating results.
I just jump in there on the BC piece of it. There's always been buyers for BC. BC is very challenging to find sellers. So I think that by 2019, sellers' expectations had gotten so maybe grandiose that they're just the bid-ask gap was too large there. If you move to talk about cap rates, the seller's expectations were like, well, if you want me to part with my asset that's in high demand and just kicking off a lot of cash flow, it's a 4 cap. And while buyers wanted to be in the BC market, maybe a 4 cap was just a little too rich for their expectations in 2019. That nobody predicted 2020, but everyone could sort of feel like 2019 was end of the cycle. We didn't have RevPAR growth in 2019. We actually had a slight RevPAR decline nationally in 2019. We had new supply coming on in a lot of markets. So there was starting to be that question mark as to how does this cycle end? And of course, nobody realized it would kind of be the crash that it was in 2020, but no.
So Carrie, since we're in a new cycle, maybe you could just go over briefly some of the new dynamics of valuations from an appraisal standpoint.
Yeah. I would say methodology hasn't changed in how we look at valuations. It's a forward-looking discounted cash flow model that we find is what sophisticated buyers will bring to their modeling. What's happened historically is relevant, but you buy a hotel based on the future cash flow that it can generate. So, what kind of demand is coming into the market? What's the effect of new supply in the market, and how's that going to drive my occupancy and rate and ultimately bottom line? So we're still trying to forecast those pieces. There's a much higher level of uncertainty around our forecasting, so that's being factored into it. And buyers and specifically lenders, because 60% of a hotel's acquisition price is typically funded by a lender. They've reset to this new cycle. So what the hotel was worth in 2019 is still playing into people's psyche, but nobody feels like it's the same number as it was in 2019. There's this question of how much is it reset, and so we're trying to model that. Is that a function of cash flow changes? Is that a function of parameter changes, higher discount rates, higher cap rates? And I think we hadn't seen a lot of real market transaction activity, because I don't think we could take the BC Housing and City of Vancouver acquisitions into consideration for true market value. They were buying it for a specific purpose. Certainly, if you were selling to them at the prices that they were willing to acquire at, there were some great deals to be had for owners there, and it worked out well for the housing authorities to be able to put people into quick housing solutions. But there wasn't a secondary market that was going to buy it after BC Housing at what BC Housing is. So we don't consider that to be a market transaction per se. So we're kind of devoid of good market transactions. We are now starting to see the market open up, and what we might have been modeling in May or June of 2020 as a 15 to 25% decline in valuation is not there. The decrease in values from 2019 is much smaller than that. That certainly than the 25%. Maybe it's somewhere around 10%, even less than that in some cases. So I think we're seeing that the pool of potential buyers are more optimistic in what they're willing to forecast going forward, and they're not pricing in a significant risk premium into the cap rate. So they're not adding on to 100 basis points, 200 basis points onto the cap rates that they were forecasting before. So I don't want to be overly aggressive in the thinking and have people thinking, oh, we saw these massive declines in demand and the market still hasn't fully recovered, but my hotel value is still the same as what it was. I don't think that's the case, but I don't think that values have declined as dramatically as we might have thought they would have a year ago. And we also don't have a lot of sellers that had to sell. We had banks being very accommodating with forbearance and providing liquidity to the sector. We've had the government coming to the table with the CEWS benefits and the CERB benefits and these different types of things that have kept hotels' heads above water to this point. And so, Russell's stat on 4 receivership transactions in the face of the sharp downturn that we saw really speaks to the fact that hotels have been able to at least manage through. Now, whether or not there's a reckoning that comes once we start to see the government funding programs pull out and we start to see the liquidity needing to be paid back, there might still be a reckoning that comes a little further down the road. But, to this point, hotels have been able to manage through. So that's from my, somewhat hypothetical modeling of hotel values. What are you seeing on your side of it, Russell, in terms of discounts from the vendors and the purchasers out there?
Yeah, it's very hard to peg, and looking at cap rates or traditional metrics, it's not the best way to really peg anything today, because it's hard to say and it's so asset and market specific. But if you do think of replacement cost and construction cost to build new hotels, it's exorbitant. And given where construction costs are and having available supply in the market for investors to purchase hotels, you're going to have activity, because it does make a lot more sense to acquire and even renovate than to build brand new in most cases, and most people's circumstances anyway. And with buying existing assets, you avoid government policies and all the timing it takes to build, and risk as well.
Mm-hmm. Why do you see, what are some of the reasons you see investors out there wanting to sell? Because it seems like there are a few more things that are coming to market, and it's not specific financial pressure from a lender or receivership sale. So what are you seeing as being some of the reasons for selling?
Yeah, it's always a mix, and traditionally private investors and hotel focused investment groups have longer time horizons, and you've had other groups like private equity companies and pension funds that have defined timelines where they need to exit, or have a very defined window where they hold the asset for, say, 5 years and sell. But we're seeing today, in the last even few years, and we're pretty focused on the fact that there's going to be a lot of non-core selling. So if you have an existing portfolio of hotels, disposing of the ones that don't fit the portfolio for whatever reason, and it's not about exiting the business, it's about just focusing the investment thesis. A bunch of other reasons could be if there's a lot of CapEx that's needed, or a PIP with a brand, a property improvement plan, or any deferred CapEx. Often it's very difficult to get the financing to do that, so it might be easier to sell and let the next bidder do the renovation program. Estate planning is always a reason as well, which is a factor. But something else that's come up are fatigue sellers. So it's owners that are just frustrated with the space and are looking to sell. So we'll probably see that over the next few years, to be honest, where you just have groups that see that it's not as big of a discount as we thought, and perhaps I can get out with a little bit, maybe a little bit of a gain versus 2019. But if you're looking at it on a cost basis, it could be a substantial gain. And there's natural times to harvest capital, and there's a lot of groups out there that are in the mindset of diversification matters today. So if you have a lot of concentration in hospitality, it may make sense to dispose, to buy something else like a rental building or a retail unit or something of the sort. And we are seeing that. There's a bunch of groups that are repositioning to enter the seniors housing market, which has some synergies with hospitality or the multi-res space. So those are some of the reasons. It's always a mix on why investors are selling. But we're seeing a lot of non-core dispositions, and I think over the next few years there will be quite a bit of fatigue selling.
Yeah.
Right. Yeah.
We've got all kinds of notes, and I'm just going to jump a little bit ahead because we'll want to leave enough time for Ingrid to facilitate some Q&A. So if there's something that anyone is a burning question that they want to pose to us, please feel free to throw that out there. But in preparing for this, Ingrid and I were kind of talking about the calls that she gets, and there are those people out there in the market that it might be time to sell. And so we wanted to kind of touch on some of the things to be thinking about if you are looking to sell or preparing to sell. Not to give Russell and the Colliers team too much of a commercial, but there's a lot to be said for using a good broker that knows the hotel space. Hotels certainly are a very specialized asset class, and you want to be able to expose the property to those buyers out there that are looking to invest in that specialty asset class. So one of the key things, if you are looking and it's you've got COVID hotel fatigue and you're ready to dispose of your property, best thing to do, I think, off the bat is to find a good broker with some expertise in that. And some other things that we were talking about is figuring out all aspects of the property and the market, so you can answer those questions in advance and you're prepared for that buyer coming in. So that's kind of why we set the stage. Where are we at in the cycle? What are the expectations about future growth? These are important things to know about your market specifically and your demand generators when you've got buyers coming in. Looking at the contracts that are in your sale or in your assets. So trying not to encumber the property long-term with contracts that a vendor has to take on. We talked about CapEx, and this is kind of an interesting one because, you know, the question is, when you're selling your house, often you spruce it up and you stage it and you put all the money into it and make it look as perfect and shiny as you can. A hotel isn't necessarily, that's not necessarily the right decision to do with a hotel. Often you're better off to leave some of that investing to the vision of what the buyer is. So you want to take care of leaky roofs, mechanical issues, things that are obvious that need fixing in a property, but the look, the feel, the renovation, the decor, sometimes that's better left in the hands of the buyer, and they can create the story that they want for the future of the asset. They can put their upside into it. But taking out the uncertainty around mechanical and structural issues with the property is a good idea. So if something needs to be replaced, you're not willing to put the capital in, at least having that building condition report or that engineering report that says this is what needs to be done, this is what the cost of that is, and here's the issue behind it. So being pretty transparent about that, that upfront. You know, selling the dream to the next person. What's the upside? Where'd the hotel come from? Where can it go to? These kind of things are useful in trying to get your expectation on pricing, but also being realistic on your expectation of pricing. That you know, I often get calls and people say, well, what's my asset worth? And you know, that's an entire exercise that we spend weeks working on. But I'll say it's some sort of discount off of 2019. You know, is it 5% or 20%? The market is going to tell you that. But one of the cautions I always have is, were you realistic about what you thought it was worth in 2019? So if you were completely unrealistic about what you thought it was worth in 2019, it could be a 40% discount mentally, and you're just not going to get a deal done with huge gaps like that. So you're kind of wasting your time if your expectations are too high. And again, you know, you can get good expertise to help guide you where those numbers are. So yeah, those are some of the things that I think that we had identified that we wanted people to think about if you were looking at coming to the market with your asset anytime soon. Yeah, one of the questions that I'll kind of preempt is, you know, is it a good time to sell, or is it a bad time to sell? What's the right time to sell? Maybe Russell, what are your thoughts on that right now?
Well, with the discount window being not as severe as everyone thought it would be a year ago, if there's a reason to exit, and it's, you know, not an emotional hold for somebody, it could be a good time today. And what we've been doing in our experience in the last, you know, call it 6 months, is taking a hotel to market, or a portfolio of hotels to market, and letting the market decide what the market value is. So doing an internal pre-COVID value, and providing some type of pricing guidance, but letting the market dictate what the discount is. And we have been pleasantly surprised how small the discount window has been in many cases. There's examples all across the country. We've done quite a few deals so far this year. It started late last year, and some are pretty small, and then, you know, others are a little bit wider. But it's all between the, call it on average, the 10 to 15% range. And we've been pleasantly surprised that pricing has held up as well as it has. And the truth behind it is there's just so much capital out there, and you never know who you're going to find. There's a bunch of groups that have different motives for buying, sometimes that are, surprising or that you don't think of, that may have different businesses or, are not traditional hotel owners, and that are willing to step up and pay a fair price in today's market.
Excellent. Ingrid, we'll throw it over to you to help us fill in the gaps that we missed.
Great, thanks, Carrie. Thanks, Russell. So there is a chat function if you've got a question that's burning right now that you can use, and I'll manage that. But we do have a couple of questions that came in beforehand as well. So, Carrie, did you answer what is the approximate average industry multiple and metric used for purchase?
Yeah, we didn't answer it specifically because it really does vary.
By market, no doubt.
It varies by market, and quite frankly, I spoke to our forward-looking discounted cash flow analysis. If you were to try and just use a cap rate right now in this environment, the question would be: are you using a cap rate on 2019? Are you using a cap rate on 2020 income? Are you using a cap rate stabilized? Those numbers can vary from a downtown Vancouver 5 cap historically to, it would be I don't even know if you could find a cap rate on, you can't do a cap rate on negative income to a much, much higher. So there's not, there's no standard number that I think that you can come up with there.
I think both of you determining sort of the value based on 2019 and anticipated recovery and, operational ROI and flow and value of the property is probably still what people are going to look for to evaluate. I have a question here. Where might I locate any resort acquisitions in the near term? And is there certain markets where there is currently resorts or hotels for sale in the province? And do you have a recommendation of where somebody would locate properties that might be currently considered for sale?
I mean, I think, unless Russell's got a burning listing that he's sitting on his desk, but I think that's, those kind of things are like, that's where you need to build the offline, the offline relationships with the brokerage community. I often get calls. I know, Ingrid, you've said you often get calls about people looking to acquire assets. We tend to be late in the game to hearing about these kind of things. It's the brokerage community that's hearing about it first. One of the other things I would mention about the resort community is those are the communities that are going to see the leisure recover the quickest. Right. So the discounts and the value that you're going to see in buying something in a BC resort community is going to be pretty minimal. Those are tricky assets to find in the best of times. Right. And I don't think it's going to be much easier during COVID. I mean, if you want to buy a motel in Northern Alberta, you can get them pennies on the replacement cost dollars right now, because that's not where the capital is going, but it will be looking more at BC and resort for sure in BC.
Yeah. East, do you have any reference? I have a question here about East Kootenay motel pricing trends. Interestingly, like the Okanagan, the Kootenays saw a pretty strong summer for 2020. And depending on what happens in 2021, do you have any regional information or insights into pricing?
Yeah, probably in terms of pricing, I don't think we have a lot of trades to reference specifically in the East Kootenays. I would say that, speaking to what I was saying about the recovery and the places that have leisure market demand coming back to, or leisure demand coming back to the market, there'll be, from a performance standpoint, that those areas are going to recover quickly than the major markets. So the the discount on that is not going to be as significant. The challenge you have in somewhere like the Kootenays, though, is that it's a pretty niche market. You've got a lot of people looking to invest in Greater Vancouver, Fraser Valley, Southern Vancouver Island. It's a lot harder to find a market in the Kootenays. So, certainly more niche, and they never command the same pricing that you might see in other larger regions.
Here's another one about properties coming into the market. Do you have, is there current properties in different areas or different centers in BC that are projected to open or build in the short term? I should have the stat right in front of me. I think there's 9 properties under construction in the province right now. There's, one in Greater Vancouver, the Versante Hotel in Richmond should open at some point this year. I think there's a couple in the Okanagan, Revelstoke, I'm trying to think if there's anything on Vancouver Island right now. So overall, there's about 9 properties, but I think that we will see new supply is always a pretty minor factor in hotel operating performance statistics in BC. There's a lot of barriers to entry, so we rarely oversupply the BC market. Unlike other provinces, Alberta specifically in Eastern Canada, there's going to be a lot more building that's happening in those areas. So we're not too concerned about any kind of oversupply situation, and it's going to be a lot more challenging to finance new hotel development in the coming years. So I think that'll put a few projects on the back burner. Yeah, that was another one of the questions about financing new projects. And I suppose with the uncertainty in the market and the uncertainty around recovery for different demand generators, obviously the banks will be a little more cautious.
Yeah, we didn't touch too much on the financing piece of it, although it's a big piece of the market and really important to think about. What made 2017, 18, 19 as frothy as it was, I think, from a valuation and an activity standpoint, is that there were a lot of lenders at the table. In a good way, we've got some of those lenders that are going to stay at the table, but it's not going to be at the levels, and they're going to be more cautious than they were in 2019. So that will, I think it's more of a challenge for the new construction market. Probably if players are coming to the table with equity and the recovery is well modeled, you'll get a decent portion of lenders that will consider financing for acquisition. It's going to be a lot harder to get construction financing.
Right. I'm just noting the time, Carrie. I think we just have a couple of minutes left. So I just invite Russell, you and Carrie, final last comments.
Russell, do you want to go ahead?
Sure. I go back to that psychology comment about vaccine rollout, and the next few months I think will be critical for turning the corner on travel restrictions and people getting the comfort that we have protection with the immunization, and we can get out and about. I'm personally excited to travel again, and I think we should have a really good fall, hopefully, with things opened up and everyone getting back to normal.
And I think, leaving it on a positive note, we always come back stronger. Demand has recovered throughout the cycles that we've seen, and always to greater levels than it was in the past. We still got some bumps in the road to get to that point, but we can tell from the capital that's out there and that the players that have stayed in the market that they're optimistic about where the market is going in the future, and so that keeps me optimistic about where things are going to be in a couple of years from now.
And those are such good indicators, Carrie, over and above what we're looking at for demand generations and what the, sort of what the rhythm of recovery looks like. To see that continued investment in the industry is very encouraging versus the other. So I'd like to personally thank both of you so much for your expertise and your willingness to spend some time with the webinar and telling them all about what your world of both Colliers and HVS is. And I really appreciate both of you making the time today. And thank you everybody that's joined us on the webinar. This recording and webinar will be available. We will send it out in our communique, and it'll also be posted on our website, bcha.com. So thank you very much. Stay safe out there. Take care.
Thank you.
Thank you.